How macroeconomic theories explain differences in currency values. Economists have generally put forth following key economic theories which elucidate fluctuations in the relative valuations of currencies. These major theories are briefly explained below. 1. The international Fisher effect. According to this theory, the value of currencies between two countries A and B would be driven by the difference between the nominal interest rates. For example, the currency of the lower nominal rate currency should appreciate against the higher nominal rate currency by the same amount. 2. The asset market model. This model focuses on how much money is flowing into any country to purchase stocks, bonds and other securities. The greater the flow of capital, the more will be the appreciation of the recipient currency. 3. The monetary model. The central bank and the treasury play an important role in controlling inflation, and concomitantly triggering expectations about future inflationary trends. Lower rates and easy monetary policy operating typically at full employment level would raise inflationary expectations about future. If credit is available easily, it will automatically lead to credit boom and consequently increase in the price level. For the real rate difference between two countries, when real rates are higher, currencies in those countries will appreciate. Conversely, countries with lower rates will decline in value. This is because foreign and domestic investors will invest in countries with higher real interest rates. 5. The purchasing power parity (PPP) is another interesting theory which states that the cost price of all commodities should be equalized across all countries. Currency of country with lower inflation should appreciate against the higher inflation country. 6. The balance of payments theory postulates that a country running larger current account balance will face a downward pressure on its currency. During the Asian flu of 1997, the currencies of Asian economies underwent massive depreciation after the number of non-performing loans of local banks denominated in the US dollar escalated. Remember, current account is only one factor in the stability of currency. Other factors also count towards the strength of the local currency. For example, the US has been running deficits for a long period of time, yet the US dollar gains periodic strength during economic crisis. This is because US dollar is considered as a safe haven currency. To conclude, these economic theories work only under specific assumptions conditions in a perfect world with little or no transaction costs and perfect mobility of capital. In the real world, there are uncountable factors which determine the exchange rate at certain point of time. These theories might work, assuming low transaction costs and other hiccups in the long run. In the short run, macroeconomic indicators are a better barometer for currency valuation.